Hello, everyone. This is clearly the most exciting topic of the day. We're going to be talking about insurance in the Bitcoin mining space. So maybe not the sexiest topic, but really important, and hopefully we'll hear why. So we'll start with some introductions. My name is Rachel Silverstein. I'm a lawyer, and I've been working for Bitcoin miners for the last about 4 years. Been a lawyer for about 4 times as long as that. And I'm a true Bitcoiner now also. Rachel, and Tommy, we're going to have them introduce themselves, please.
Hi, I'm Rachel Nixon. I help lead our digital asset team at IMA. IMA is the third largest privately held insurance broker. We are employee-owned, which we really think makes a difference. And we do employee benefits, we do property and casualty business insurance, surety bonds, and then the executive risk suite of services from directors and officers, fiduciary crime, cyber, tech E&O, etc. We work with publicly traded companies as well as private, and then we work across a broad range of verticals within the space, from Bitcoin miners, metaverse, blockchain, exchanges, Web3, etc. Thanks for having me. It's great to be here today.
Tommy?
Tommy Shuchuk. I am head of underwriting at Evertas. Been in Bitcoin since 2016, mining since 2019, insurance for longer than that I care to mention. And today, Evertas focuses on the mining verticals on a property and BI basis, as well as custody and exchange and on-chain risk. And presently, we insure about 30% of the global hash rate on Bitcoin, not just in the U.S., but in other jurisdictions around the world.
And Tommy, you quickly mentioned that you're also a Bitcoin miner yourself.
Correct, yep.
You want to give us a brief synopsis on why that's helpful in your insurance job?
Yeah, sure. So I started a smaller insurance company back in 2020, early 2020, right after we got into mining. My background is international risk placement through Lloyd's and Bermuda and other areas of the world, and it was really difficult to find insurance coverage on our miners at that time. And so that was an eye-opening experience. And so as we got more comfortable with the operations and started scaling up the mining, we got much more attuned with what the variables of the risks are and the operations and economics and alignment of risk alignment with insurance. So we decided to build an insurance company around just specifically the mining vertical, property, casualty, and business interruption. And given the experience that we have, we essentially wrote the contracts that insure our products today. But from the mining perspective with, my background in insurance. So it was a pretty good marriage. And that's really helpful because when we're actually analyzing the risk, right now I think we're the largest single underwriter of mining risk globally. So we're able to deploy $360 million of capacity on a per declaration basis. Generally that translates to a per location basis. And no one else at the moment can do that much, but that's solely because of the data and the expertise that we have and the mental capital that we deploy on analyzing the risk and understanding what those operations look like and how we can translate that into the language of risk to our capacity providers and our authorities in London.
Cool. So, like I said, much like lawyers, insurance is one of those things that you don't really want to think about until you need it. So we are going to try and keep the discussion today very practical and useful for the miners in the audience, so that hopefully you come away with something that you can implement in your business going forward. So with that being said, Rachel, I'll ask you, give us kind of an overview of the insurance world, how a broker like yourself and a carrier like Tommy work together, and what you're going to do when a client approaches you with some sort of insurance need.
Yeah, thank you. Our goal is to be an extension of our clients in their risk management department. So we want to help them from all things risk mitigation And being a broker, we have broad market access. So we have access to great carriers like Tommy at Evertas, as well as other carriers. And our job is to put together the best lineup of carriers from a coverage standpoint, making sure that's as robust as possible, but always working on cost containment and keeping that at top of mind as well.
So, to get right to the meat of it, what types of policies should Bitcoin miners have, and how should they think about the limits to those policies?
Yeah, great question. And what's interesting is that there's definitely not a one-size-fits-all that's out there. Some of our clients like having insurance as kind of that sleep at night, and then some have a greater risk tolerance. So one thing we do is we have a lot of access to data and analytics to look at what the probable maximum loss is, and then help walk our clients through, do they have a large spread of risk, or is it more concentrated? And help them determine what they're comfortable with from an insurance limit standpoint, from a coverage standpoint, and then put that together with options from our carrier partners so that they can determine what their level of risk will be. That being said, we definitely recommend property for all of our clients to cover the infrastructure, the assets, the machines, as well as workers' comp, general liability, directors and officers insurance. And cyber is one that's really touching every business now. So that's not new, but it's something that literally is touching every business. So that's definitely at the forefront of discussions we're having with our clients.
Anything to add, Tommy?
Rachel put it together pretty succinctly. The thing I would probably add is on the cyber side, if you're a self-miner, it's really first-party cyber insurance. So you can actually bifurcate the risk. A cyber policy generally includes first-party, that's for you, the actual purchaser of the policy. And then there's a third-party aspect, which doesn't really relate to you if you're self-mining. But if you're hosting, you have more of a third-party exposure than you do a first-party, because that's the third party is the liability. So if you screw up or someone breaches your network and, let's say, points hash rate at another wallet that's not your client's or something like that, if you're managing those operations, you would want something in place to defend you against that negligence. But yeah, I think Rachel's pretty spot on with everything she said.
So, want to ask you guys, what is the most common claim that you see being made for Bitcoin miners? Is it weather related? Is it a breakdown in a facility that causes damage to machines? Is it theft? Is it cyber? What is the most common thing to go wrong?
I'm going to try to be kind here. The most common one we see is really one of negligence when it comes to running operations. And what I mean by negligence is understanding the manufacturer's specs, how the machines need to be running optimally. There could be cases where maybe you rent out a warehouse and you turn off the power or not the power, but the HVAC system, and you're using the ambient air cooled miners to essentially arbitrage the heating in the building, but then you lose power due to a blizzard, and all of a sudden now your mining equipment's in negative 21 degrees temperature Fahrenheit in the warehouse, and now all of a sudden they're damaged. Things like that. And those are easily mitigated if you are properly managing the operations and understanding what the limitations of the hardware is. But a lot of that comes with time and experience. And so what we see from our more institutional miners on the public side and large private ones is really they're more exposed to, I'd say, black swan events, things that you can't necessarily plan for, but just occur, right? And that's generally well within the actuarial tables of our underwriting. The more frivolous claims occur with newer miners that don't necessarily fully understand the operations and are being more opportunistic as entrepreneurs.
Yeah, I think the only thing I'd add is that, fortunately, there have not been a ton of claims in the industry. Unfortunately, it's that people are underinsured, or the underwriter didn't understand what they were underwriting, and so the policy isn't going to respond to their actual operations. Maybe they don't have enough insurance. Those are obviously unfortunate circumstances that can arise.
So, talking about property insurance specifically, if a miner wants to insure their property, mostly ASICs, of course, how are the rates comparable to other industries, and how do you deal with the fluctuating fair market value of those ASICs?
I would say, unfortunately, it's inflated, even though as Bitcoiners, we would argue that insurance shouldn't necessarily have to be. But there's kind of a crypto tax, is what we call it, where some of the underwriters, Tommy excluded, don't understand the risk as well. And so while underwriting is getting used to this risk, there's a little bit of an inflated price. Which, again, we're trying to do a lot of education with the carriers that are out there to get them more comfortable. Insurance typically wants hundreds of years of data, and being this is a newer and emerging risk, we just don't have that yet. So it's a constant conversation with our carrier partners to say, here's why you don't need to be afraid of this risk. Here's why it's okay. And then one thing we do for our clients is the brokers bring in great underwriters like Tommy who really understand the risk and how to underwrite it. And then as relates to the pricing fluctuations, we try to be very proactive in monitoring the price throughout the year. And if we do see big fluctuations, reaching out proactively to our clients to say, hey, do we need to adjust the pricing on how you have the miners in as relates to your total insured value right now? Because ultimately, we don't want our clients to be either overinsured or underinsured. So we're having that proactive conversation throughout the year with them.
Yeah, I think, Rachel, you did a really good job explaining that. I would disagree slightly with the terminology of crypto tax. I would more call it a lack of data, conservative math, if that makes sense. Because, like you said, there's hundreds of years of data that you have for traditional property markets to influence exactly what those actuarial tables look like and the common vectors of risk or the most likely causes of a loss and what those percentage of losses are going to look like on your total book of business. We just simply don't have that. And now that's a catch-22 though, because the only way you get that data is by actually underwriting it and insuring it. So we're kind of in this this really weird time in the insurance market where you really do need expertise on the underwriting side to fully understand the operations to actually translate what this might look like in a claim scenario or from an actuarial perspective as to how profitable or unprofitable the business is going to be, and then taking that data and extrapolating it into how to underwrite it and charge an actual premium for it. So fortunately, we think we have a pretty good beat on that so far, but there's always things that can just occur that really just screw you up, like a black swan event. Like a tornado drops out of the sky, it's F5 in Rockdale, Texas, and all of a sudden Bitdeer and Riot are just gone, right? That would be pretty detrimental to the industry if that happened. But you really can't plan for those things. You just have to try and account for them mathematically. The other component is really from a valuation standpoint, I think it's very important to have agents and brokers that are very familiar with the industry that check in on at least a quarterly basis with the miners to say, hey, especially post-halving, okay, guys, right after halving, if you didn't have your agent or broker checking in with you saying, hey, what's your fleet worth now? That's probably not good, because everybody knows that the value of their assets basically halved overnight along with the block rewards. So there's definitely more touch points that you should have when addressing the proper risk management strategy that you're deploying and the risk transfer solutions you have with the policies you're buying. That being said, I think monthly is a little excessive, but quarterly certainly is good. And then if Bitcoin goes parabolic or there's a price movement of say 20%, and it stays there for maybe 2 weeks, as we know the secondary market and the ASICs, those values probably translate to a 2 to 3 week lag time on the price of Bitcoin. Not to mention hash rate on the network. I think those are all different metrics that would trigger you to say, all right, maybe I need to look at this. And so, for instance, most insurance carriers, because they're not familiar with this space, they don't understand the fluctuations of values, right? So you could quantify this in a way of saying, all right, if someone insures oil, they're used to the trading volume of oil as a commodity, but they're not used to the wild swings that you see in the ASIC market as a computer that is a commodity that's secured by the underlying value of Bitcoin and hash rate on the network. So when we underwrite a client and they say, hey, I've got $100 million worth of values, and we insure that day one, and then 6 months later they come back and say, hey, our values are not 100 million anymore, they're 40. Can you pro rata return premium to us? We have no problem doing that because we understand, that makes sense. And it's really like a bell curve. Like if you're insuring it over here, you're also going to get the benefit of insuring at the top of the bell curve, but then you're also going to have to weather the storm on the back end of the bell curve, right? But consistently over time, from a profitability standpoint for us and insuring it, we're in it for the longevity because over the long term, you're going to have a flat curve on that basis. So we're very comfortable with all that, but it is nuanced, and I think the best way to combat that is keeping the lines of communication open with whoever's representing you so that you can adequately address your concerns as they happen and as the market moves.
I totally agree with that. I think communication is key between the broker and the carrier, the broker and the client, proactive communication, ongoing communication, so that we can adjust on the fly as needed, just to make sure, again, we're not overinsured or underinsured. And that's why we think the industry knowledge is so paramount to success, because if your carrier doesn't understand what you're really doing, they're not going to understand when you want to adjust the pricing on your ASICs mid-year or even quarterly. But if they do, it just is better for everybody, that understanding and that open lines of communication.
Really helpful information. Thank you. Let's talk a little bit about business interruption coverage. Maybe give us a 10 or 30 second primer on what that is. How is it different for miners versus other industries? And what trends are you seeing in the business interruption world?
I can take that. So one of the innovative things we did was we were really the first to standardize the offering of business interruption on our policies. We have a different take on it, though. So if you think about traditional business interruption, it replaces lost profit or revenue, right? That's really challenging to do when Bitcoin miners' revenue is denominated in Bitcoin. So that's difficult from an actuarial base, and it's really hard to get, especially if you're playing with hundreds of millions of dollars worth of capacity like we are on single risks. It's hard to get insurers and actuaries on board with understanding, even if you're doing it on a daily look back, like what that looks like and how to price it. It's actually nearly impossible for them. So rather than fighting that uphill battle, what we decided to do was, what are the biggest things that really affect miners in the event of a loss scenario? And really that's, okay, if you have a PPA agreement, if you are trying to service debt, if you've got payroll, all the things that are costs or expenses associated with operating your mining computers, those costs are actually fixed as you scale your business, right? And generally power purchasing agreements, those are in place for 3, 4, 5, 10 years, whatever it may be. But you're basically locked in on a long-term basis, and most of our policies are 12 months. So we re-underwrite every 12 months. So what I'm really saying is, what we did was we tied business interruption coverage to fixed costs and expenses, which then, if you think about it, when you're not 90% of your operational expenses for a miner, it's energy and electricity, generally speaking. So if you're not operating, let's say there's something that happens and your mine is wiped out essentially, or the power's gone, you're not operating, and it's a covered loss on the policy. Really, what that does is, the expenses that you would have paid will pay you because they're fixed, but you're not incurring them. So essentially, it's like quasi-income replacement, if you think about it that way, because you're also not incurring that cost at the full scale. If you'll have a minimum on the PPA, you probably have to pay. But that's how we think of it, because those expenses are all fixed, and it's much more easy to model that and underwrite for that versus a variable value of Bitcoin or rewards that occur after halving, right? And as the mining difficulty increases. So it's challenging from that perspective. It's much easier to do it on the income expense related basis. Now, the only way to ensure true revenue replacement for miners or Bitcoin related exposure is, in our opinion, with Bitcoin. So, that would be the solution there.
And
are there any Bitcoin-denominated business interruption policies out there?
Can't say.
Trending. Hopefully coming soon.
I like that, trending. Did you have anything you wanted to add, Rach? Okay. So when a mining client comes to you, Rachel, and actually, I think this question is more directed at Tommy as an initial answer. What are some of the easy infrastructure or security related changes that they can make that make them more attractive to a carrier? Yeah,
it's really, really simple, and I would venture to guess most miners already do it. The first one we like to see is at a bare minimum 24/7 surveillance or having security guards on site. Generally 24/7 surveillance, CCTVs, cameras around the property, and that being serviced by a third-party vendor. really easy to do, and not really costly. The second thing is it depends on the operations, but if you're in more of a warehouse data center build out of infrastructure, or if it's a containerized data center solution, a lot of times, especially with ambient air, the centrally monitored burglar and fire alarms don't really make sense because of the flow of air. Burglar alarms, obviously, that helps. Making sure the facility is gated and locked, having secure entrances to the building, making sure the containers have their own separate locks. Those are all really helpful, but making sure that there's also adequate fire protection at a bare minimum, basically fire extinguishers that are compliant with NFPA 10, which basically you'd have an annually checked amount of fire extinguishers, maybe one on each container, and then also like at different entrances and exits, and strategically in like different warehouses or data centers. Those are the bare minimum things. The things that we see our institutional clients do really well is, the public companies that mine, generally they have 24/7 security guards on site, which gives, from an emerging risk standpoint with insurance companies that are insuring this space, that gives a lot of confidence to them, mainly because if you have someone on site 24/7, like it's rare that something would go wrong that you're not aware of relatively quickly. So that really helps, especially when you don't have the data to support a lot of the things that we're really talking about in terms of how to underwrite it. So it's rare that you would find a fire suppression system, like a clean agent fire suppression system, but if that exists, that helps too. A lot of carriers don't like liquid immersion because technically the liquid immersion oil-based solution is, it is flammable to a certain degree. We really like it because it's more of a closed environment. You have less breakdown of equipment. Generally, especially in hotter environments, you run those and you typically underclock the machine, so you have less breakdown, wear and tear. I actually think the liquid immersion facilities are better protected and are a better risk than, say, the ambient air-cooled facilities.
I think I would just add from a high picture, we just really value communication, again, between the carriers and your broker, and then we communicate that back to the carrier as the broker. Because anything we can do to say, hey, here's the improvements that are being made, here's how it's being retrofitted, here's how security is being improved, will allow us to push the carriers just to say, hey, this is a best-in-class risk. Let's price this accordingly. Let us advocate on your behalf as the broker. And so the more data you can give us, the more communication on the improvements you're making to the facility, the better, and then we'll communicate that back on your behalf to the carriers.
So, Tommy, a few of the things you mentioned sound like they were geared towards preventing theft, and we've seen a number of reports lately about minor theft. Is there coverage available for that, and what does that landscape look like?
Yeah. So yes, all of our policies cover theft. Obviously, you would have to breach the deductible, so the loss would have to be higher than the deductible. Now, in most of these scenarios, it's fairly hard to steal a bunch of miners that are already racked and operating. You'd need a few hours to do those things, which is why we like the 24/7 surveillance. Because if someone's on site not authorized, you're probably going to know about it pretty quickly. We knock on wood, we really have not seen many theft events at all. On site. When we do see a theft event, it's generally from assets that are in transit. So you could be at a way station with a truckload of something, and then maybe the driver's been on the road too long, steps out of his truck, and then someone breaks into the actual semi and then steals a pallet or something like that. We've seen that actually happen in the last year. I've seen that happen maybe 5 times. We don't insure the transit stuff. We're going to try and get into that pretty soon. But that is where I see most of the frequency on the theft side, not necessarily on site.
And there are other carriers that could help on the transit from a cargo standpoint until Tommy gets there, and then we'll go to Tommy.
That's a more narrow risk. So yeah, that's a little more saturated of a market. But yeah.
So let's move into D&O coverage. Is it different at all for miners? And if so, how? And what trends are you seeing in the D&O world, Rachel?
We definitely recommend directors and officers insurance for all of our clients. We think that's very important. The pricing is inflated compared to a widget manufacturer, but we are recently seeing the pricing start to soften. There's more capacity coming online. Underwriters are getting more comfortable with the risk. So we are seeing it improve. It just, again, takes time to educate those carriers as well as to why the risk is a typical directors and officers risk. And they shouldn't be afraid of it.
Anything specific? One thing I've seen come up a lot in my practice is environmental risks at some sites. Anything specific with respect to D&O liability for environmental liability issues?
Yeah, that's something we always want to help our clients evaluate, from environmental pollution, like Tommy said, the dielectric fluid. So it's always a conversation. Again, we want to assess all the risks that our clients could be exposed to, and then come back and present options for, here's what your coverage would look like, here's what it would cover, here's the deductibles, so they can go in very eyes wide open to what options are out there from a risk management standpoint, and then they can pick their limits, their coverage accordingly with kind of what falls into their risk tolerance levels. But it's definitely a coverage that we always help our clients explore.
There's one specific scenario that may or may not fall under the guise of pollution, and that would be something that's really being highlighted right now in Granbury, Texas, with the noise emissions that are affecting the residents of Granbury. And it'll be very interesting to see how that plays out. There is legal precedence for things of that nature, specifically in manufacturing towns, with or people that live near an airport per se. There's certain things you can and can't do. Given the fact that it's a newer industry, we actually, on our general liability policies, will cover that. But I could see that something leaking in the directors and officers area, because again, ultimately, that's a management decision as to how you're mitigating those issues for the residents of the community that you're operating in. So I don't know how that's going to affect things, but that is a trend that we're watching right now and we're aware of.
I'd also add that for public miners, it's essentially a requirement to have D&O coverage. So some miners are considering expanding into the HPC AI world. What are some differences that y'all are seeing in how those sites get covered versus Bitcoin mining sites? And how do carriers view the two industries differently that would be helpful to miners?
As a Bitcoiner, I don't think there are a lot of differences, but the carriers so far do not agree. There are admitted markets and non-admitted markets, and your admitted markets, such as like your Hartfords, Chubbs, Liberty Mutual, etc., are not comfortable with writing the Bitcoin mining space yet. We're trying to educate them again on why they should, but so far those carriers are sticking to more of the AI, HPC, GPU underwriting, which is it's less pricing for our clients, and obviously that's ideal, which is why we're continuing to push those carriers to why they should want to write the Bitcoin mining space, just like they do a data center space currently.
The biggest difference between HPC and AI compute versus Bitcoin mining, and we're in both spaces, is really the aggregation of risk on a square footage basis. So H100s, a cluster, 72 of them in the open market, I think go for $500,000. Brand new from the manufacturer, but in the secondary market, you could probably get, I think, close to $1 million for that. I mean, that's a very real disparity in valuation, specifically when you're talking about lead times of 55 plus weeks from the manufacturer to get them. So if you're going to have to replace them, that could be a very challenging situation for anybody that's indemnifying a client for a claim like that. We're fairly comfortable with it because of the risk controls around those operations. But the biggest hurdle, I think, for most insurance companies is to say, okay, I have a 25,000 square foot warehouse. Half of that, or data center, half of that is actually deployed with H100s or GPU clusters, but that's roughly, call it $120 million in 12,000 square feet. Probably less than that. that's a huge exposure for them in one very specific area. You don't have a lot of diversification there, and so that's the part that really scares a lot of the insurers, because they don't see that type of aggregation of risk with, you know, that's exposed to essentially one single weather event or something like that.
So I just got the 2-minute warning. So with our last 2 minutes, you know, as counsel to minors, I know that an insurance policy is really just a really long contract. And so the devil's in the details on how those contracts get written and applied and claims asserted under them. So real quick, if you could just give us a quick horror story on where things can go wrong in policy writing, coverage, etc., and then we'll wrap up.
So we'll do a policy review for a prospect of ours, and where we'll read all of the policy language, figure out where there's gaps, holes, coverage, and then come back with a very transparent review for them. We reviewed a publicly traded miner's policies, and we're like, this carrier doesn't even understand that you're mining Bitcoin. So that was a very extreme example, but that's the last thing we want to see. We don't want people buying insurance and then in the policy language, in the details, and not actually covering what they're actually doing, which is mining Bitcoin. Then if you have a claim, the claim's not going to pay because the carrier is going to say, I didn't know you were mining Bitcoin. That's not what I underwrote the policy for. So that's a horror story. We never want to see that happen. As the broker, we'll always perform those transparent reviews for our clients, because at the end of the day, we want the coverage to ensure what you're actually doing as a business and what your operations actually are.
Yeah, so we're an insurance company, but we buy insurance as well. So we have our own policies that we have to carry, directors and officers, errors and omissions, all that kind of stuff. As a consumer, the first thing that I look at immediately on any policy is I immediately go to the exclusion section on the form. It's its own little section. It literally says exclusions, big bold letters, and there's usually about at least 25 of them. Read that. That'll give you a really good idea as to what is not covered. And that's probably what you want to focus on. And then for everything else, I would consult with your broker and say, hey, I noticed all these things are not covered. Is there anything else I should be aware of that's more nuanced in the language? If you understand the exclusions, you understand the intent of the contract. That's number one. Number two, there is... I lost my train of thought, but that's the big one. Yeah, I'll stop talking.
That's good advice. Rachel Nixon, Tommy Shuchuk, thanks, guys.
Thank you.
Next year, we are bringing the Bitcoin Conference to the American West, Las Vegas. The brightest minds in the world will converge to deliver Bitcoin history. Buy your tickets now at b.tc/conference/2025.